Welcome, everyone. Today, we're diving into something that might sound a bit dry at first, but is absolutely crucial for anyone involved in running or managing a business: the five-step corporate financial planning process. Now, I know what you might be thinking. Finance? Yawn. But stick with me, because understanding this process can be a game changer for your organization. Whether you're a small startup or a large corporation, having a solid financial plan is like having a GPS for your business journey. So, let's break it down step by step. First up, we have the foundation of it all: defining clear financial goals. Imagine you're setting out on a road trip without a destination. You might have a great car and all the snacks you need, but without knowing where you're headed, you could end up lost or going in circles. That's what happens when a company doesn't have clear financial objectives. It's not just about throwing out some vague targets like increase profits or cut costs. No, we're talking about specific, measurable goals that give your company direction and focus. Think about it. When everyone in the organization knows the financial targets, it aligns efforts across departments. Sales teams know what revenue numbers to hit. Marketing can strategize around those goals, and finance can allocate resources accordingly. It's all about creating a sense of purpose. Plus, when you set clear goals, you establish benchmarks to measure performance. And who doesn't love a good metric to track progress? It motivates the team and keeps everyone engaged. Now, the nature of these goals can vary widely, depending on your company's size, industry, and stage of growth. For example, a tech startup might focus on maximizing profits through innovative products, while a manufacturing firm might set specific cost reduction targets to improve their bottom line. Whatever your focus, make sure those objectives are crystal clear. Next, we move on to the second step: data collection and analysis. This is where we roll up our sleeves and get into the nitty-gritty of financial information. You can't make informed decisions without understanding your financial landscape, right? This step is foundational because the insights you gather here will inform everything that follows. So what kind of data are we talking about? Well, start with your revenue streams. You need to know where your money is coming from. Are there specific products or services that are driving sales? Are there seasonal variations you should be aware of? Then, dive into your expenses. A detailed analysis of both fixed costs, like rent and salaries, and variable costs, like materials and utilities, can reveal potential cost-saving opportunities. And let's not forget about capital expenditures. These are the funds you use to acquire or upgrade physical assets. Analyzing these expenditures is crucial for long-term strategic planning. Are you investing in the right areas? Are those investments going to pay off down the road? Once you've gathered all this data, it's time to analyze it. Financial ratios can be your best friend here. Ratios like the debt-to-equity ratio or profit margin give you quick insights into your company's financial health. You can also look at trend analysis to identify patterns over time. Are your sales growing? Are costs increasing? This information is gold for making strategic decisions. Now, on to step 3: creating accurate financial forecasts. This is where we get to play fortune teller, but with data as our crystal ball. Financial forecasting is essential because it helps you anticipate where your company might be headed financially. Think of it as a predictive map for your business. Why is this so important? Well, first, it aids in strategic planning. By understanding potential future conditions, you can set realistic goals and allocate resources more effectively. It also helps in risk management. By identifying potential financial risks and uncertainties, you can develop contingency plans. And let's be real, no one wants to be caught off guard when the market shifts or an unexpected expense arises. When crafting your forecasts, you can use historical data analysis to look at past performance, market trends to gauge external factors, and predictive modeling techniques to analyze current data. And don't forget scenario analysis. It's crucial to consider best case, worst case, and most likely scenarios. This way, you're prepared for whatever the future throws your way. Now we're getting to the meat of the process: Crafting the financial plan. This is where all your hard work comes together to create a comprehensive blueprint for your company's financial future. A well-structured financial plan is essential for guiding your financial decisions and actions. It's like your business's roadmap, ensuring you stay on course toward your goals. What should your financial plan include? First, detailed budgets outlining expected revenues and expenditures are a must. These budgets help you manage cash flow and control costs. Then, you'll want financial projections for your income statements, balance sheets, and cash flow statements. These projections give you a tangible view of your company's financial health over the coming years. Don't forget about funding strategies. If you're looking to expand or invest in new projects, you need a solid plan for acquiring capital. Whether through equity financing, debt financing, or internal cash flows, this is a critical component of your financial plan. And speaking of investments, your plan should also outline where you'll allocate surplus funds for maximum returns. Finally, let's talk about risk management strategies. Identifying potential financial risks and outlining how to mitigate them is essential. This could involve diversifying your investments or having contingency plans in place. And to keep everything on track, establish key performance indicators, KPIs, to monitor the plan's performance. So, why is a well-structured financial plan so impactful? For starters, it ensures strategic alignment across the organization. All financial activities should support the company's broader goals. Plus, it enables informed decision-making. With a clear plan, management can make educated choices about investments and resource allocation. Now, we're at the final step. Implementing and monitoring the financial plan. This is where the rubber meets the road. It's one thing to have a great plan on paper, but it's another to put it into action. Clear communication is key here. Everyone in the organization should understand the financial plan and their role in executing it. You also need to allocate resources effectively. Make sure capital, personnel, and technology are aligned with the priorities set in your financial plan. And don't forget about training. Your team may need guidance on new processes or systems to ensure effective implementation. Setting milestones is another great strategy. Break down your financial plan into achievable short-term goals. This not only helps maintain focus, but also provides opportunities for early course corrections if needed. And remember, integrating financial planning with day-to-day operations is essential. Financial considerations should always be part of strategic decision-making. Now, regular monitoring and review are crucial. You need to track those KPIs and performance metrics to assess how well the plan is working. Schedule regular reviews to evaluate progress against your goals and objectives. And don't forget to establish feedback loops. Insights from various departments can provide valuable perspectives on the plan's impact. But what if things change? The business environment is dynamic, so your financial plan needs to be adaptable. Stay vigilant about market trends and be prepared to adjust your strategy accordingly. Your financial plan should evolve as your business grows, whether that means scaling operations or entering new markets. Lastly, don't overlook contingency planning. Having backup plans for unexpected events or crises is essential for ensuring business continuity and financial stability. In conclusion, the 5-step corporate financial planning process is a strategic approach that can steer your business toward success and sustainability. Remember, it all starts with defining your financial objectives. Then, gather and analyze your data to inform your decisions. Create accurate forecasts to guide your strategic planning, and craft a comprehensive financial plan that serves as your roadmap. Finally, implement and monitor that plan to ensure you stay on course. Financial planning isn't a one-time event. It's an ongoing process that requires continuous refinement. By consistently reviewing and adapting your strategies, you can navigate the ever-changing business landscape and drive your company toward greater prosperity and profitability. So, whether you're a seasoned finance pro or just getting started, embrace this process and watch your business thrive. Thanks for tuning in today. If you found this information helpful, don't forget to like, subscribe, and share with your fellow business enthusiasts.